The statement that the United States owes trillions of dollars has become one of the most repeated phrases in modern economic discourse. It appears in political debates, news headlines, online discussions, and public anxiety about the future. The number itself is often presented as proof of impending collapse or moral failure. Yet rarely is the statement followed by the most important question. If America owes this money, who actually holds the debt? Debt, by definition, cannot exist without a creditor. Understanding who owns us debt, why they own it, and how this ownership shapes global finance is essential to understanding whether the debt is a weakness, a tool, or something more complex altogether. U.S. government debt primarily exists in the form of Treasury securities, Treasury bills, notes, and bonds. These instruments represent contracts between the U.S. government and investors, promising interest payments and the return of principal at maturity. Rather than being a single obligation, U.S. debt is a vast network of millions of such contracts distributed across the global financial system. These securities trade daily in deep liquid markets, making U.S. debt not merely a liability but also a cornerstone of modern finance. The debt's significance lies not only in its size but in its function. Contrary to popular belief, the majority of U.S. debt is not held by foreign countries. Most of it is held domestically by American institutions and individuals. Pension funds, mutual funds, insurance companies, commercial banks, state and local governments, and individual investors collectively hold a significant share of Treasury securities. In addition to these private holders, parts of the U.S. government itself own large amounts of Treasury debt through intergovernmental holdings. This means that, in many cases, the United States owes money to itself. Intergovernmental debt is one of the least understood aspects of the national debt. Programs such as Social Security and Medicare collect revenues that exceed their immediate expenditures. These surplus funds are required by law to be invested in special Treasury securities. From the perspective of these trust funds, Treasuries are assets that will finance future obligations. From the Treasury's perspective, they are liabilities that must eventually be honored. This internal borrowing does not eliminate the obligation to repay, but it fundamentally changes its nature. It is not a foreign claim on U.S. resources. It is a deferred internal obligation tied to future fiscal policy. The dominance of domestic ownership explains why the U.S. debt has been able to grow without triggering immediate crisis. Institutions such as pension funds and insurance companies require safe, predictable assets to meet long-term liabilities. U.S. Treasuries serve this purpose exceptionally well. They are considered among the safest financial instruments in the world, not because the United States is flawless, but because its political, legal, and financial systems have historically supported repayment. Treasuries are also highly liquid, meaning they can be bought and sold easily without significant loss of value. This combination of safety and liquidity makes them foundational to institutional finance. Banks, too, rely heavily on Treasury securities. They use them as collateral in lending markets and as reserves to satisfy regulatory requirements. In many ways, Treasuries function as the plumbing of the financial system. Their presence allows credit to flow smoothly and markets to remain stable. This structural dependence explains why demand for U.S. debt persists even as the total amount outstanding continues to rise. Foreign ownership of U.S. debt, while smaller than domestic ownership, still plays a significant role. Countries such as Japan, China, the United Kingdom, and various oil-exporting nations hold large quantities of Treasury securities. These holdings are often misinterpreted as leverage over the United States, but in reality, they are a consequence of how the global economy operates. Nations that run trade surpluses with the United States accumulate dollars. Those dollars must be invested somewhere, and U.S. Treasuries offer one of the most practical options. Central banks hold treasuries as part of their foreign exchange reserves. These reserves are intended to stabilize currencies, manage trade flows, and provide financial security during crises. For these purposes, assets must be liquid, stable, and widely accepted. U.S. Treasuries meet these criteria better than nearly any alternative. Their role as a reserve asset is not a reflection of political loyalty but of systemic utility. There is a persistent fear that foreign countries could destabilize the United States by selling off their Treasury holdings. While large-scale selling could cause short-term market disruptions, it is unlikely to produce catastrophic outcomes. Rapid selling would reduce the value of the seller's remaining holdings and could strengthen their own currency, harming exports. Moreover, the global demand for safe assets means that Treasuries would likely be absorbed by other buyers, including domestic institutions and other central banks. The structure of the market makes sudden, unilateral financial attacks impractical. Another source of confusion is the concept of default. Because the United States issues debt in its own currency, it has the technical ability to create dollars to meet its obligations. This makes an outright failure to pay extremely unlikely. However, there is a more subtle form of default that occurs through inflation. When inflation erodes the purchasing power of money, bondholders receive dollars that buy less than anticipated. This does not violate contractual obligations, but it does redistribute value over time. Historically, many heavily indebted governments have relied on inflation as a mechanism to manage debt burdens. The sustainability of U.S. debt depends less on its absolute size and more on its relationship to economic growth and interest costs. As long as the economy grows and borrowing costs remain manageable, debt can expand without immediate consequences. Problems arise when interest expenses grow faster than national income, forcing difficult fiscal choices. This dynamic does not lead to sudden collapse but to gradual pressure on policy, markets, and public confidence. Perhaps the most important but least discussed aspect of U.S. debt is how deeply it is embedded in the global financial system. Treasuries serve as benchmarks for pricing a wide range of assets. They underpin derivatives markets, collateral agreements, and risk models used worldwide. A serious loss of confidence in U.S. debt would not simply affect the United States. It would destabilize global finance. This interconnectedness creates strong incentives for gradual adjustment rather than abrupt change. Public discussions about U.S. debt often focus on fear rather than structure. Large numbers are emotionally powerful, but they obscure the mechanisms that actually determine stability. Debt becomes dangerous not because it exists, but because it is misaligned with long-term policy, institutional credibility, and economic capacity. When governance weakens, signals of stress appear long before crises erupt. These signals are often subtle, reflected in rising borrowing costs, policy inconsistency, or shifts in investor behavior. Ultimately, the question of who holds U.S. debt reveals that the issue is less about external threats and more about internal alignment. The sustainability of the system depends on maintaining trust among domestic institutions, foreign partners, and global markets. Debt, in this sense, is not merely a burden but a reflection of confidence. As long as that confidence persists, the system continues to function. When it erodes, the consequences unfold slowly, often invisibly, until they can no longer be ignored. Understanding U.S. debt through this lens replaces fear with clarity. It reveals a system that is complex, interconnected, and resilient, yet not invulnerable. The future of American debt will not be decided by a single creditor or a single moment, but by the gradual evolution of trust, policy, and economic reality. Recognizing these dynamics allows observers to look beyond headlines and focus on the deeper forces shaping financial stability, quiet signals that emerge long before confidence breaks.